Hi, and welcome. I'm Clark Atterbury, President and Financial Advisor with Atterbury Investment Management. If you'd like to benefit from lessons learned from over 50 years of investment experience, you're in the right place. As a financial advisor with over 30 years experience myself, I've had the great privilege of working with a number of high-level institutional investment professionals. Our guest today is one of the best, Mr. Tom Nugent. Tom earned his MBA from Rutgers University and studied investment management at both Stanford University and Dartmouth College. He began his now 56-year investment management career as a research analyst on Wall Street back in 1968. In 1984, he began managing the investment department at J&W Seligman & Company, a New York mutual fund company. In that role, he oversaw the management of both investment research and investment portfolio managers and personally managed a number of Seligman's mutual funds. He also served as vice president and high-yield fixed income manager for Security Pacific Investment Managers. Since 1994, Tom has been executive vice president and chief investment officer for PlanMember Securities, where he developed and still oversees PlanMember's retail and institutional advisory programs. He and his team are responsible for analyzing the direction of the economy and financial markets, as well as mutual fund evaluation and portfolio design. He currently manages over $6 billion in client assets. Please help me welcome Mr. Tom Nugent. Say hi, Tom.
Hi there.
In today's economic and political climate, what are the key principles of prudent long-term money management that you think investors should be focused on?
Sure, Clark. And I don't know if you want to use the conjunction "and" with economic and political, because we're maybe going in two different directions here. But I mean, for the long-term investor, and I mean, obviously there are a lot of short-term investors too, and that's a difficult road to go down as far as how to handle that. But as long-term investors, and as you know, managing the portfolios at PlanMember, most of those portfolios are people saving for retirement. So almost by definition, those people have a long-term perspective. Right. So when we build these portfolios, what essentially we're sensitive to is, the fact that in the short run, there may be some events that take place. And as you know, based on my experience, we've been through a number of those strange events. But what always seems to happen is we recover from those events. And my point here is that for those saving for retirement, long-term is, first of all, you have to take a long-term perspective and not be upset by the market volatility on a day-to-day, week-to-week, month-to-month basis.
Amen.
And when we had tough times back in 1974 with the Arab oil embargo and double-digit inflation, the market, I think the S&P was down like 45%. But, things improve after an event like that. And I remember going back to 68 when I was starting in the business, the Dow Jones Industrials was 900.
Yeah.
Today it's 37,000.
Right.
So if you have patience and you wait is the first principle. So let's call it time. Okay. The second principle in your investment portfolio is diversification. Right. What you have to do is be sufficiently diversified so that any one or two or three investments in your portfolio don't destroy your portfolio. I mean, there's so many stories about people that work for companies in their 401k plans, and guess what? They hold only the stock of the company. They're not diversified. And we have a number of cases, I mean, even GE, where people held a stock and it went down 70 or 80%. And by the time you get to retirement, they didn't have enough money saved. So by diversifying, history tells us that you can get a reasonable return of, say, around 8 to 10% in a well-diversified portfolio with not a lot of risk outside of the risk of market volatility.
Just for those watching, Tom is not the one who interfaces directly with the clients. Tom manages money when advisors like me, or like we, direct our clients' assets to him. So we're the ones who are interfacing directly with the clients. And I can't tell you how many times I've seen people come to me and they've got 95 or 100% of their 401k in their company that they work for. I was with Bank of America years ago, and a lot of those employees felt very loyal, and they put everything in it. I was always saying, you never want to put, no matter what it is, you don't put all your money in one stock because Enrons happen, right?
Right. And even when you're diversified, and this is where hopefully the plan member management ability comes in handy. Even if you're diversified in a fund, the example is the S&P 500. But even if you're diversified in a fund and something goes wrong in that fund, you could lose your money. Even if that diversification doesn't help you there. So in our opinion, you need some type of intermediary that evaluates how you're diversified, how well you're diversified. The example that I give, I go back to an individual fund that we held. I won't mention any names, but what happened to this fund, it was a high yield fund, and it had a very attractive yield. But all of a sudden, we noticed that the fund was more volatile than other high yield funds. So my job under those circumstances is to call up the fund company and talk to the fund manager. Well, I talked to his assistant, and I got it out of this guy that what they were doing was investing in mortgage-backed securities when they should have been investing in high-yield bonds. So what we did was we turned around and went back to our investment committee and said, these guys are violating what they're supposed to be doing. And so we got not all of our clients out of that fund, which then subsequently collapsed and never came back. So there is value added. I mean, you just don't go out and say, hey, this guy told me to diversify, so I bought XYZ fund that had 10 stocks in it, and I felt diversified, and something goes wrong. And there's other cases where the mutual fund company changes managers. I remember going back in the early 2000s, and a value fund did really poorly, so they fired the fund manager and brought in another fund manager, and this is in 2000, who bought all growth stocks in the fund. And the growth stocks caved in during 2000 up to 2002.
Well, so that was another
mistake. So you can have diversification, but there's got to be, I think, a third party to make an evaluation of what that diversification means and how risky it is.
I've always said to my clients, I've always noticed that with my clients, for the most part, they're smart enough to build an asset allocated, diversified portfolio. But they're going to make usually the emotional mistakes that we all make, as opposed to keeping the professional long-term perspective. And I can't overstate the value of having professionals do it for you instead of trying to do it yourselves. So where I think we bring value to the investor is, they've sacrificed, they've saved, they're the hero of the story. They've built up this great nest egg. We just want to guide them towards what they're trying to achieve. And the value that I can add as an advisor and bringing a professional like you into the equation is priceless. Which brings me to my next question. How can investors navigate the emotional part of the market and stick to their long-term investment plan?
John Bogle, the founder of Vanguard, probably had the most extremely valuable long-term perspective on this. But he basically said, look, put your money in an index fund and go to sleep for 35 years. And when you wake up, you're going to be really surprised at how well off you are. And I think the problem that a number of investors face is they get lured into some of these, what I call flim-flam presentations about things. And it just misleads them. And then they're watching these news stories or these money managers on CNBC, and they're buying this or selling that or doing this. That's a way to really, have to take Nitol, at night, because what's going to happen to you under those circumstances is you're going to get sucked into some guy coming on and saying, oh man, the crisis is right around the corner. We're going to go into the hole. And these people, a lot of them are around, and they're probably most bearish at the bottom of a market decline or bottom of a correction. And what do they tend to do? they tend to influence these investors who are too short-term oriented. So theoretically, there could be a big event. But I haven't seen it in my lifetime that would basically say we're not going to have any more bull markets. The stock market's not going to go up. I think we're just going to have short periods of time when the market corrects, and the rationale is here that some people made a lot of money in a stock and they decide to sell it and go into another stock. And that will cause some market volatility. But the really key thing is to get out of this emotional battleground is to just, watch NBC Today and watch the interviews there with the movie stars and stay away from focusing in on the
financial markets. Yeah. What you said about going to sleep for 30 years reminds me, I often say to clients, I say, be like Rip Van Winkle. Take a nap, lean against the tree, wake up 30 years later and everything. You'll go, wow, Clark, you're a genius. You did so great for me. It's funny you talk about the long-term investment horizon. A couple of investors come to mind. One is a senior client who says, I don't have that much longer. So how do I think long term when I don't have that much longer? And in this individual client's case, I said, well, are you going to spend that money? And she's like, no, that's for my kids or my grandkids. Like, okay, well, whose time horizon are we talking about here then?
Right.
For example, another client just popped to mind, a lady who has her investments in an IRA account. And she said, this was a little while back when the markets were down at the moment. And she said, well, what if I die and the markets are down? I said, well, if your kids are smart, they'll take it as an inherited IRA and leave it invested for their long term. And it won't matter that it was down at that particular point in time. So yeah, the long-term perspective is critical.
But then again, it's been my experience that most people get out at the bottom of market declines. So that's what makes them, okay? The thing is do they get back in? I probably don't see those people, you get a call and they say, I'm really afraid of this market. I'm going to cash or whatever, or I'm going to bonds because bonds are really safe. And then the market turns around and rallies and then bonds go down. And all of a sudden, what's happening here, right? They're just basically missing the boat. I mean, I can't tell you how many people keep postponing getting back in, and the more the market goes up, the more they're wringing their hands. So now they were worrying on the downside. Now they're looking at a cash portfolio that's yielding 3 or 4%, saying, and then watch the markets going up 10 or 15, and saying, when should I get back in? And it's painful to watch.
It is painful, and it hurts. In my career, I can think of a couple of clients who wouldn't listen to my advice, got out when things were near the bottom, and lost money. Or, they were down from their high at least.
Right, sure.
And it's always such a shame. I think of it like this. The client, we're here, the elevator goes down. Rather than waiting for the elevator to go back up again, the client gets off the elevator in the basement. Elevator goes roaring back up to the 30th floor, and they're down here trying to climb the stairs to get back to where they were before. It's always a shame when the clients do that, but luckily it's a rarity. And I think where we as advisors add value is to help clients not make those mistakes.
Well, I've used the analogy of how wacky that decision-making process is. As I said, if you're interested in buying a new Lexus, and you open a newspaper and you come to that page and say, hey, Lexus is on sale today for 30% off. That's like saying, well, I'm changing my mind. There's something wrong with that car.
I'm not going to buy it until it goes back to full price.
Or the other flip of the coin is I turn to that page and the ad says, well, you missed it, but now Lexus is up 20%, the car price. And you say, well, something must be better than I know. I'm going to go out and buy it. Does that rationale make sense? But it's the rationale that's applied to buying or investing in the stock market.
And as you said, they're turning on CNBC or whatever news channel and getting the scary news. And And we have to remind our investors that the news media is not your friend. It is sensationalist. They're all about the click, all about the ratings, and the more scary and terrifying they can make it, the better for them, but not the better for the client. That one client I just mentioned about taking the elevator down and getting off, he was watching the news all day long, and he was hearing things like, "You think this is bad? Wait till next quarter. It's going to be awful." And he heard that so much he couldn't stand it anymore and got it out in the basement. Aside from the emotional thing, what are the most common mistakes you've seen investors make?
Well, I think, we sort of summarize them here is they concentrate their investment, they have bad timing, they follow the crowd. And I think, other than those three mistakes, I can't think of any other ones of major proportion, because when you get into, if you're an individual stock picker, the problem run there is there's an infinite number of risks you're taking based on the company and the marketplace and regulation, and we could go on and on about that. I also think that going outside, and again, I'm a bond and stock guy, all right? So that's the bias that I'm going to use here. But remember that the important thing here is that you invest in a diversified stock portfolio because you're investing in companies whose mission is to grow and have profits and ultimately pay dividends. Okay, that's the focus long term. In the case of the bonds, the bond essentially is going to be an investment. If you buy an individual bond, is the interest payment on that bond is the return on that. And you'll keep your fingers crossed that if you're reinvesting that interest, that it can be reinvested at the rate of the bond. Now, it can be affected over time. If interest rates change, you'll get that reinvestment rate at either a higher or lower level. But that bond part of the portfolio, you can use the current interest rate as a reasonable forecast for the return on a bond or a bond portfolio like that. So you mix these two things together and you know exactly what to expect going forward. When you invest in other entities outside of these markets, these two markets, take a Bitcoin as an example, or even gold. You're investing really on the basis of expecting someone will buy that from you at a higher price in the future. That's the only reason to own it, right? I mean, and there's no what I call dynamic principle in those types of investments as there is with individual companies. I started out as a stock buyer back in 1965, and I still believe today, a well-diversified stock portfolio, and I tend to lead towards growth stocks, but a blend of or value portfolios over long periods of time, they will tend to get close together with the returns is the best way to save for retirement in a knowledgeable and less volatile way. Let me just give you one example. I met with a client back in the early 1990s, elderly lady who basically owned Coca-Cola stock. And the dividend on the stock was higher than the price she paid for the stock. How about that for a growth story?
Right.
And that's over the very long term. But I mean, if you can identify companies like that, that pay consistent and potentially increasing dividends because they become more profitable, that's a sure winner.
I love it. I couldn't agree with you more. How do you approach actively managing the mix of investments within a client's portfolio to ensure continued alignment with their long-term goals and risk tolerance?
The basic principles of PlanMember is that we manage what's called a life cycle strategy. And a life cycle strategy is the creation, and this is arbitrary, but it's 5 different portfolios. And each of these portfolios contains some mix of bond funds and stock funds. So you get complete diversification.
Let me interject for 1 second. If anybody's watching this, if you're not quite following the idea, imagine a pie. You got a pie in front of you and it's cut into 10, 12, 15 different slices. And each slice of the pie, your portfolio is invested in these different kind of things like Tom's talking about. Go ahead.
What we're trying to accomplish here is in the early years. And when we started out way back in the 90s, the primary client was people who were school teachers in 403B plans. So what we tried to get across there is the idea you want to start investing early and grow the amount of money you have at a reasonable rate. So what we do for those people is we don't have any strange names. It's called Portfolio 5. But that's the portfolio that's virtually all the time invested in common stocks, diversified common stocks. And within that portfolio, there are different what we call asset classes in that portfolio within the stock market. So, and again, these are arbitrary, but they're a traditional way of looking at different sectors of the stock market. For example, we all have a weighting in large cap growth stocks. We'll have a weighting in small cap value funds. So there can be a distribution of these. It can be more than one of these types of funds because we know that over short periods of time, there's a lot of volatility. And the volatility in this at this point in time is a positive contributor to this portfolio. Why? Because for these teachers, they're doing dollar cost averaging, which means they're putting in money out of each payroll. And so that goes in to buy something. And so over short periods of time, something that's down, you're going to buy more of. And something that's up, you're going to buy less of. Okay? But over the long term, those things will sort of trend together. So this is, the perfect buying technique to grow a portfolio by systematically investing in this portfolio over time. So as you go through time, you're expected your portfolio is going to build up, both because of the market increases historically and the amount of contributions you make. So then you may consider investing in a portfolio that introduces some bonds, which are much less volatile and have generally a stable return on them. And that portfolio will have what they call a different risk-reward mix. So as you go through your years to retirement, there can be a gradual shifting through these portfolios. And as your value builds, you systematically reduce the amount of volatility in the portfolio. Okay, that's a well-known traditional approach. Right. And again, the 5 people that work with me, our job is to continue to monitor what's happening with those asset classes and what's happening to the weightings in the portfolios. And sometimes when things get out of whack, we rebalance the portfolio a little bit. We don't do it systematically, okay? We just don't run out and sell winners and buy losers, which is another way to look at rebalancing. But we systematically look at what's going on in the world and say, maybe we should be a little heavier here or a little lighter here because of these factors. Mm-hmm, mm-hmm. Then you get down maybe to portfolio 1, which has the least amount of stock and the most amount of bonds or bond equivalents. That's expected to be sufficient to maintain or get a little ahead of the inflation rate, but not dissipate any of the portfolio value that you've built up over a lifetime.
Would you agree, Tom, that like you said, that's a traditional concept of going from the 5 to a 4 to a 3 to a 2 to a 1 over time as you age? Would you agree that that's not necessarily the best way to go, and that perhaps it might depend more on the objectives of why they're investing? Like I said, my elderly client who wasn't investing for herself but for her kids or her grandkids, just because you're 80 years old doesn't mean you need to be in a 1 portfolio, the most conservative of all bonds. Would you agree?
I more than agree. I'm 82, and I've been invested in portfolio 5.
You look marvelous, by the way.
Thanks.
So back to the concept that as we age, we don't necessarily need to go from an all-stock portfolio to an all-bond portfolio. It's more true to what we're investing toward, right?
Yeah. And another important distinction I want to make here that I haven't so far is that there are 3 major programs that we have structured in this life cycle approach. One is called the Elite Program, which is our most popular one. That consists only of index funds in all these categories. Okay, And the value added here relative to an actively managed portfolio is the expense ratio runs about 6 to 8% for the funds there. Whereas in an actively managed portfolio, you could be paying upwards of 1% for
You said,
expense.
I think you said 6 to 8%. You mean basis
I
points.
apologize. 6 to 8 basis points. I apologize.
0.06. Yeah.
Yeah, 0.06. So what happened is when we introduced this program back in 2005, I mean, advisors said, wow, I'm going to be able to save my clients over 1% per year in expense ratio. And I mean, the program really took off to a point today where it's attracting about $40 million a month into that program.
Yeah.
Now, the second program we have is the Elite Hybrid. A little bit like a hybrid car, half electric and half gas. In this particular case, we have index funds like we have in the Elite program, but also actively managed funds. Mm-hmm. And here we're really trying to ferret out funds that will add value where we can't find an equivalent index fund to meet that. So you may find us 60, 40, 70, 30 index to non-index there. It's the second part of the program. And the third part is actively managed funds. In other words, we're looking for funds where the manager of the fund is trying to outperform an index that he's benchmarked to. And the question then becomes is, in our judgment, can he or she do that? Or a team, they're teams of managers now. And so those are the three types of programs. And we find that there are both advisors and clients that say, I want active, or I like the cheap product. That type of conversation takes place. But all three of these programs continue to attract substantial amounts of money on a monthly basis.
Let's talk for a second about active portfolio management versus market timing. So folks, if you're watching this, we think it's foolish to try to time the markets. Everybody who's been in this for a while knows that. Like Tom said in the beginning of this interview, if you're going to time the markets, you have to have perfect timing on the way out and perfect timing on the way back in. Interesting number that I heard was that the average stock mutual fund historically has averaged something like 10% per year, where the average stock mutual fund investor has averaged something like 4% per year. And why there was that difference is because of the emotional decisions and trying to get in and get out versus just staying in. So we discourage market timing, but we do believe in active portfolio management. Can you talk about the difference of that, Tom?
Well, I guess both of them are active management. The only thing is, and we're back to square one again, you're making an all-in, all-out decision. It's going to depend on your ability to make a guess as to where the market's going. And many years ago, I managed a mutual fund, a growth mutual fund. And the management company that I worked for, they would allow market timers to go into this fund, to go into and out of this fund, because they got a fee. I really frowned upon this, but they let this happen. And obviously, it caused the balance of the shareholders a loss of return, because there's a cost of accommodating these guys moving 30, 40, $50 million into and out of that portfolio. What I found in monitoring these guys, they never were right. I mean, you got to be really hard to be consistently wrong. Okay? Now, maybe there's some guys out there that do better than that. I mean, batting zero, you don't play on a team too long when you're batting zero. But of late, I haven't seen too many market timers out there that cannot say, we're great market timers. We were out at this point, at that point. You give them your money, and then they miss it the next 3 times, and you lose money. It's a tough short term. That's short term. That's short term investing, which is a very tough business to be in. Now, let's shift back. Let's take, for example, the PlanMember Elite portfolios, 5 portfolios. The characteristics is that the funds are passively managed. Okay? So there's no fund manager out there that's trying to do something better or tricky or whatever. Okay? So we rely on the fact that these index funds are benchmarked to an index that we have data going on to back to 1926. Okay? So we look at that data and say, here's a reasonable long-term return for this asset class. So when we build the portfolio, we use that long-term return as a starting point to come up with a target return for that portfolio. See, in an actively managed portfolio, like our active product, we really can't do that because we don't have a long-term history of returns. All we have is a guy or a girl or a team that says, look, we're going to beat this benchmark. We're going to do better than this benchmark. I mean, I got my fingers crossed that we've made the right decision in picking these people to manage the portfolio. I mean, it's like, picking the guys that play on a basketball team or a baseball team. So from our point of view, what we're doing is we're blending the concept of active management in the sense of asset allocation and passive management from the diversification management of the individual mutual funds in that portfolio.
Talk a little bit, please, about how you make changes. You mentioned a moment ago, you don't do it just because a quarter has passed. You're not going to change the allocation to a 3 portfolio just because 3 months have gone by, but rather you're doing it because of what you're seeing going on in the economic, perhaps political climate. Can you talk about why you make changes, when you make changes?
There can be a number of whys. It can be an economic reason. It could be a political reason. It could be a market reason. For example, very recently, when we came into this year, the consensus of economists were that, well, we still might have a recession out there someplace, and that the Fed is likely to cut rates 4 to 6 times. This was the prevailing wisdom.
Right.
So in our investment committee, we basically said, hey, if this is the case, maybe, because from a bond perspective, for a number of years, we've taken a very low-key approach and had short-term bond funds or high-yield funds, which are safe but have, in our opinion, and have a high return. Okay, we never went out and did 30-year government or 30-year corporate bonds. We were all intermediate. Okay, So when we had an investment committee meeting, we came up with the idea, maybe we should, if this is going to be a peak in rates here, maybe we should gradually begin to invest in long-term bonds. Okay, that was the feeling of the committee. Mm-hmm. So when that happens, we can't just do that. We have to go to what we call the investment committee, which consists of the senior management of PlanMember as well as an outside consultant. Mm-hmm. And we lay out our logic to them. Basically say, this is what's happening. This is what we think. We're going to turn around and begin. We recommend turning around and beginning to invest in higher yielding, longer term securities.
And that'd be a portion of the bond portfolio.
But what will happen is things didn't work out that way. We got a little bit of an increase in inflation, and the Fed panicked again. And the Fed says, we're not going to lower rates now. Wait a second, you guys said it was going to look like it was going to be 4 or 6, then 2, then none. And then I think it was in the paper this morning, the Fed won't raise, will they? So we're in sort of a period of time when the economy didn't behave as expected. Okay,
imagine that.
So what happens is, we'll turn around and our strategy would be, we're not going to do that. We're not going to go to long bonds because we don't see a clear line to a potential decline in interest rates in the near term. Now, we happen to believe that the inflationary uptick is temporary. One of the key elements that we watch, really key, is the price of oil. And the price of oil recently has gone from 90 to 79. That's a real good indicator to us that, looking out to the summertime and into the fall, inflation is going to be back on the downside.
So it's this kind of intelligence and cooperation among several professionals with decades of experience that guide the allocation changes from time to time as deemed appropriate.
Yes.
Let's talk about taxes. When you consider tax implications, what are some strategies for optimizing portfolio rebalancing within the client accounts?
Okay, let's shift from 401k, 403b, IRAs. No tax consequences there, so we don't worry about that.
Right.
Now things get a little testy when it comes to managing taxable accounts, and obviously you have to be careful. And again, here's where the idea of rebalancing makes, in my opinion, makes no sense. Why systematically pay capital gains tax when you don't have to? But that's what rebalancing does. You sell your winners and you buy your losers, right? So that's the first thing that I would be real sensitive to. A strategy that makes sense to me is selling your losers and holding your winners, or rolling into your winners. Keep with the good guys, and you can be fortunate enough to maybe accumulate some losses. All right, so you essentially can use those losses to offset the prospect of capital gains.
Are you able to do that within the portfolios? Do you look at it during the course of the year and say, we can harvest some losses? Is that even a part of the consideration?
No, we do not do that. And let me tell you why we don't do it. Because we're using index funds. Indexes don't trade stocks. They are based on the capitalization of the companies. Mm-hmm. Now, once in a while, a company will be taken out of the index. But in any case, it's been our experience that there is very low capital gains distributions from index funds. So by owning this type of a portfolio in a taxable account, you're already ahead of the curve when it comes to taxes. Whereas in an active fund, you can get a lot of capital gains distributions, especially in a good year.
Right.
I mean, I guess in 2020, people could have gotten hit with substantial capital gains tax liabilities.
Right.
Whereas that wouldn't be the case in an index. Implementing a tax strategy is really going to be at the advisor level. Right. And that advisor has to deal with each individual client's circumstances. And obviously, we don't know that. We can't react to that. So, we'll obviously delegate that tax decision to you. I think we're on the cusp here of another major economic advance because of artificial intelligence. I go back over my career, and early on, I remember in 1979, I saw the first Apple computer. And I used computers all through the 80s in money management, all right? And it was a wonderful time. It was like the Wild West. That's what would go on with. And then along comes the internet. Yeah. And the internet brings on another technological advance. And the stock market's huge moves were based on those types of breakthroughs. And I happen to think that this one, is the icing on the cake. I mean, I think that it's going to go for some time. I don't know what stops it other than, abnormal regulation of what people are doing. But even then, AI can move around the world, at a click of a computer mouse. So, I continue to be quite optimistic that investing in U.S. equities, where investing in AI is by far and away higher than the rest of the world combined, will pay huge dividends to America. And we will once again emerge as a major leader economically.
Thank you for sharing that. I know in the portfolios we do participate internationally. So even, with what you said in mind, we are diversifying. One thing I always share with clients, when I was born, correct me if I'm wrong, 75% of the world's stock market capitalization was United States. The rest of the world accounted for something like 25%. And now isn't it about the opposite? 25% of the world's stock market capitalization is U.S., 75% of it is at the rest of the world. So it seems like as a part of a balanced diet, it's good to participate in the rest.
Well, obviously my strategy or outlook is not shared by everybody. So that you do get a lot of people that want to invest in emerging markets. Emerging bond markets can have much higher yields than domestic bond markets. So if you have confidence in legitimacy of that market, you can obtain a higher rate of return in those markets. But you would have to be well diversified, of course. I mean, I think it's funny when you go, I off the top of my head, I forget, but one of the major companies that has launched this fat pills, or fat injections, Novo Nordisk.
Right.
I think Novo Nordisk is like 80% of the market of the country. I forget, was it Belgium or Netherlands? I forget where it is, but it's like 80%. I mean, it's huge. I mean, I think Volvo, no, not Volvo, used to be, what was the phone maker that we don't remember the name of anymore?
I don't remember.
It's in Norway, or Norway has the company there, like 80% of the market. So when you begin to diversify internationally, you got to also be careful about how many stocks are in that market, because that could really up your volatility perspective. I mean, we see year to year, you see the Russian market's up 50%, and the Turkey market's up 210. And you go look at them, and then the next year they're down 30, 40. I mean, it's a roller coaster for some of those, what I would call third world countries.
Right. That's why I love the indexes. That's why I love the PlanMember Elite Index portfolios, because if we have a slice of our pie in international, it's not in a stock or two; it's in hundreds of stocks. I share with clients, we all know better than to put your eggs in one basket. You don't want to invest in one stock. Similarly, you don't want to invest in just one stock market. You can diversify among different markets, building this pie, and then in turn diversify within each of those markets, within each slice of the pie, by implementing it using the index funds. Right. So we ultimately end up owning thousands of things. Then you add on top of that the wisdom and experience that you bring to the table, and your team and the other senior management people. You all put your heads together. I love it. It's a great portfolio. So
experience doesn't guarantee success. Well, the key thing for me in working at PlanMember was I came across, at one of our big meetings, I came across a representative who was pouring enormous amounts of money into Elite. Enormous. I mean, I was flabbergasted when I saw how much money he was putting his clients into Elite. And I said to him, why? I mean, why are you putting all this money into the Elite program? And he just basically said, because we have confidence in what you're doing. And that means a lot more than just explaining what we do, is to have past that certain level of confidence. It's like when you're a teenager and you fall in love, it's before love and after love. I mean, you're a different person, right? And this is the same thing. I mean, once we have, either through experience or demonstrated results or our presentations, that we pass that barrier with a representative, quotes, he loves us, and has confidence in what we do, then a couple of things happen. One, PlanMember does well, but the advisor does well. And the reason is that he doesn't worry anymore. He can go out and build his client base as much as he wants and not say, I don't know if I want to invest in X or Y or other thing. I mean, and it's the same thing with some advisors that like to invest their clients' money themselves. And I try to explain to them, why do you want to do this?
Yeah.
What are you trying to accomplish? What you're going to accomplish is get in trouble.
Yeah.
Because you end up making a bad decision. The client says, you never told me that. And all of a sudden, you get a subpoena and there you go. I mean, it's your time and your money and you didn't do anything wrong, right? But because you made those decisions, and you've seen the regulatory authorities, how tough they are now in this area, they're getting tougher and tougher and tougher.
Yeah.
So I say to many reps, why do it? Just let us do it for you. And then you can devote your time to building your business.
Or as I say to our clients, even if, people go, I know all about the markets, I follow the markets, I watch CNBC and all that. Question is, do you want to spend your time doing that? Or are there other things in your life that maybe are important to you? Some passion you have, or spending time with your kids, your grandkids, whatever, something that your time would be better spent on than watching the markets all the time, and try to match your skills up against a team of professionals who've been doing this for 50 years or more.
Right.
Are you able to describe your investment philosophy and how it guides your approach to managing client portfolios?
Basically say the philosophy is, number one, we believe in capitalism. We believe that there are two dynamics in the world today. The first dynamic is the capitalist dynamic, and that companies run by individuals, their mission is to grow the business, create profits, and are given incentives to do that. So that's why many of these people work 12, 16 hours a day, work as hard as they can, think as hard as they can to beat the competition. I mean, it's really a dynamic process. On the other side is the politics. The incentive for politicians are to get elected. Their incentives is not to help companies, really. I mean, if you basically say that giving $60 billion to the chip industry is a good idea, and they're wanting to help the chip industry, they're not helping the guys that didn't get the money, okay? Okay, that's like industrial policy, the government getting involved in the private sector. But, aside from that, it seems to me that government regulation is an overhang for the free market system, and more often than not does damage rather providing help. So it's our belief that although there are headwinds in a political context, it's the genius of the private sector that will continue to be the basis for individuals investing for the future. And we can't look around the corner, but we're pretty convinced that when we do go around that corner, there's a bright future out there.
What are some key trends you see shaping the future of the investment landscape in coming years?
Yeah, as I mentioned before, I can again drill down on this whole idea of artificial
AI. Yeah.
But let's do another analogy here. I mean, it's going to be like, once we get past this first wave, it's going to be like the gold rush. And the guys out west panning for gold. And people will tell you that the guys that made the money were the guys that sold the picks and the pans.
Right,
okay?
right.
And I say that because this whole AI thing, and by the way, just as an aside, there's a guy by the name of Ray Kurzweil. Some people may or may not have heard of Ray, but he's worth a look. He's the principal inventor of, or creator of, the concept of the singularity. And in his writings, he talks about what these advances are going to do for us. And he may be way out there on Venus someplace, but when you read some of the things that he talks about, life is going to be wonderful in one sense. That our lives, our standards of living are going to be able to be improved, because we're going to have more time. And he says you're going to live longer, because instead of, and a micro example of that is, you used to have to go to the shopping at the grocery store. Now you don't have to do that anymore. And a million examples of things like that are going to give you more time. Okay. Mm-hmm. So what I see happening here is that the companies like the medical profession, the retail industry, auto industry, one by one, as these companies rapidly apply the breakthroughs in AI, they're going to be extremely profitable for that. Now, there's the downside to this. Okay, let me warn you about the downside. And again, I'll use the analogy of the Industrial Revolution and the rapid increase in the development of farm machinery, which allowed the supply of goods, of food, to explode. But at the same time, it put a lot of farmers out of work, or people that worked on farms. They didn't have to harvest the wheat any more than machines did. And so there was a lot of negativism towards the Industrial Revolution because of the impact on workers. And we may see that again, even though AI will do wonders for us as individuals, there's going to be segments of society that will suffer. And as that's recognized by the political class, my expectation is that you're going to see various pressures to curtail the applications of AI. And run-of-the-mill people I talk to, they say, oh, that's bad. AI is bad. Now I'm afraid of AI. Why are they? Because what they see is, they see the Terminator. They see the AI creating the Terminator and machines taking over the world.
Right.
That's what they see this as. And as long as you have this fear factor, there can always be the problem that is, you go around that corner and there's a cop there instead of a
RoboCop.
Right.
I want to thank you for taking your time to speak with us today. I'm going to head towards the landing to get you about your day. What advice do you have for young investors just starting out on their journey?
One story that will get them to start investing a little bit the younger they are, even if it's some of their Christmas money they get for gifts or something like that. And the story that I tell is, let's say that I'm going to pick the Vanguard S&P 500 fund as a place where a parent can open up an account for their child, okay? And they explain to their child that this is where you should save your money because it's a good place to save for when you're a lot older. Mm-hmm. The story goes is about there's two people that have 401ks at work. And the first person is 20 years old. They're both 20 years old. But the 20-year-old begins to save for their future in their 401k plan. And they save for 8 years. So at age 28, they stop. Okay? Now the second person starts saving at 28 and saves until they're 65. Okay? The first person has more money in retirement than the second.
A lot more money, right?
Yeah, because what happens in those 6 years, the rate of return on that investment each year subsequent to that time exceeds the amount of the contribution the second person makes. And so you'll never catch up.
Compounding. Yep, indeed. Well, thank you. I'm going to come back to you for one more thing. Before we go, I just want to share with people, Tom is accessible through advisors like Keely and me. So, if you're interested in accessing the kind of skills and talent and resource that we have through there, work with a PlanMember advisor, you can reach out to us. And I just want to share with you real briefly our website. You can find me at clarkatterbury.com, and you can learn about us there, including links for making an appointment. You can set a time for a phone call or an online appointment to sit down and talk. I also want to point our viewers to our YouTube channel, where you can see all kinds of videos on other things like that, investments and retirement planning, and how we like to guide our clients. So one final question for you, Tom, before we let you go. Looking back on your career, what's one piece of timeless investment wisdom you'd share with our audience?
Be patient. You can, if you want to go short term, go to Las Vegas. That's short term. You're going to be doing the same thing, effectively the same thing. But if you're saving for having a comfortable retirement, be patient. Start out with some of the principles that I've talked about today. Have confidence that they're going to work, and then go to sleep for 35 years.
Well, thanks again, Tom. I'm really grateful to you for taking the time out of your busy schedule to share your experience with us. So say goodbye.
Take care.